Welcome to vTalkInsight, Risk Sentiment Daily for February 13th, 2026. A sharp pullback in equities, stickier inflation worries, and an AI-driven shakeout are colliding with still robust growth, forcing portfolios to decide how far to move into defense. Risk sentiment has shifted into a more cautious and defensive gear. The latest session saw a broad equity sell-off, with the S&P 500 down around 1.5% and volatility back above 20, while the Nasdaq 100 dropped about 2% and AI-exposed names came under heavy pressure. Beneath that headline risk-off move, the picture is more nuanced. Strong payrolls, resilient private sector hiring, and the most accommodative U.S. financial conditions since 2022 still support a soft landing narrative. Yet those same data have delayed expectations for Federal Reserve rate cuts, kept front-end yields elevated, and reinforced a higher-for-longer policy bias. At the same time, cross-asset signals point to stress building under the surface. Equity dispersion is high, AI-linked sectors are swinging sharply, and traditional hedges like the dollar are proving less reliable, pushing flows toward gold, staples, and other perceived havens. Taken together, today looks like a defensively balanced market, with investors still holding risk, but doing so more selectively as policy and AI uncertainties mount. Higher-for-longer Fed expectations are a central bearish driver today. A much stronger than expected U.S. payrolls report, with job gains more than double forecasts, has pushed the implied timing of the first rate cut from June out toward July and effectively taken a March move off the table. Fed officials are reinforcing that message, stressing the need to keep policy restrictive to avoid re-entrenching elevated inflation, especially with growth and core PCE still projected above target. Markets now expect only a couple of cuts this year, and there is visible skepticism in the Treasury curve that easing will translate into a sustained fall in yields, with both 2-year and 10-year rates holding near the top of recent ranges. This higher-for-longer backdrop is weighing on more rate-sensitive parts of the equity market, where small caps have struggled to sustain outperformance and cyclicals increasingly look dependent on policy relief. It also adds uncertainty around valuations in regions priced for perfection, such as Europe, where even earnings beats can see negative price reactions. Against that, emerging signs of disinflation in consumer goods and shelter could still give the Fed cover to tilt more dovish later in the year, but for now the policy overhang is a clear brake on risk appetite. AI disruption, volatility, and concentration are another major headwind for risk. Recent sessions have seen indiscriminate selling across sectors perceived as vulnerable to automation, particularly real estate services and other high-cost intermediaries, where names like CBRE and Cushman have suffered their worst setbacks since the pandemic. At the same time, index leadership remains heavily concentrated in a handful of tech and communication services giants that are viewed as AI winners. Since late 2022, only those sectors have truly outpaced the S&P 500, leaving benchmarks reliant on a narrow group of stocks. Credit markets echo that theme, with large tech issuers driving much of the new borrowing to fund AI infrastructure, raising concentration risk even though spreads remain tight. Company-level news is amplifying that volatility. Cisco, for example, flagged margin pressure from a great memory crunch in chips, while AI-related fears are hitting service businesses and some consumer platforms. Layer on growing political momentum for AI regulation and you have a recipe for sharp swings and potential wealth damage. Markets are increasingly concerned that this mix could trigger an equity shock in coming weeks, unless the narrative clearly shifts toward identifiable, durable AI beneficiaries. Defensive rotation and flight to safety flows are the third key bearish driver. Investor FOMO has shifted away from equities toward gold and silver, with central bank buying and even stablecoin issuers adding to demand. At the sector level, consumer staples are outperforming, supported by both affordability pressures on lower-income households and fears that AI will disrupt more cyclical, higher-cost industries. Traditional hedges are also in flux. The dollar has weakened roughly 9%, and its role as a reliable offset in risk-off episodes is diminishing, while long-duration treasuries are not delivering the diversification benefits they once did. That is pushing allocators toward commodities, especially precious and industrial metals, and even private assets as alternative ways to manage portfolio volatility. This defensive tilt does not mean investors are abandoning risk wholesale, but it does show rising caution around equity beta and index-level exposure, particularly in regions and sectors where valuations are rich and earnings are priced for perfection. The next test will be upcoming inflation and labor prints, along with any escalation in geopolitical tensions, which could either entrench this rotation or allow a partial swing back towards cyclicals and growth. On the bullish side, AI-driven growth and earnings resilience continue to support risk appetite in selected areas. Fastly jumped more than 40% on an outlook that implies earnings could double consensus by 2026, explicitly tied to AI-driven demand for digital content delivery. Semiconductor companies report strong visibility and high margins for at least the next 2 years, helped by acute memory chip shortages that are boosting pricing power for names like Micron. Industrial players such as Siemens highlight record order backlogs and see AI accelerating, rather than replacing, demand for simulation and automation software that is deeply embedded in physical processes. Investor surveys still show a majority with a constructive view on earnings, particularly in the United States, and U.S. tech valuations have actually become more attractive versus value stocks after recent rotations. Importantly, classic signs of a late-stage bull market peak, such as imminent recession or aggressive Fed hikes, are not yet apparent in the data. That combination suggests AI-related growth could continue to underpin indices, even if leadership becomes more selective and execution discipline around AI spending tightens. Rotation toward Asia and non-U.S. assets is another important bullish driver. A weaker U.S. dollar, down close to 9%, and a belief in a multi-year de-dollarization trend are encouraging global investors to rebalance away from U.S. equities and dollar-denominated holdings. Liquidity is increasingly flowing into Asian markets, where equities are outperforming at their fastest pace since at least 2000, and Asia-Pacific benchmarks have been beating the S&P 500 at a rate not seen in decades. Earnings growth in Asia and broader emerging markets has also been stronger this year, reinforcing the case for diversifying beyond Europe and the U.S. mega-cap complex. Major asset managers are already cutting U.S. exposure in favor of Asia and other international markets, framing it as a multi-year shift rather than a tactical trade. Over the near term, this rotation helps explain why global risk appetite can look weak in U.S. indices while remaining robust elsewhere. The main risks are political and trade tensions, including potential changes to agreements like USMCA, which could periodically disrupt cross-border supply chains and capital flows. Finally, loose financial conditions and strong credit markets continue to underpin the bullish side of the ledger. U.S. financial conditions are now the most accommodative since 2022, even after the recent repricing of Fed cuts, supporting expectations for continued economic growth over the next year. Credit spreads across U.S. and international markets sit near multi-decade lows, and recent record-sized bond deals from tech giants such as Oracle and Alphabet have been heavily oversubscribed. Investors remain comfortable funding long-duration growth, while high-quality credit, including investment grade and selected high yield, is still viewed as attractive in a soft landing scenario. Bank fundamentals add another layer of support, with healthy loan and deposit growth, strong credit quality, and ongoing share repurchases, painting a constructive picture for the sector. That said, tight headline spreads do mask growing dispersion and concentration risk, particularly in tech-related borrowing and long-dated government bonds, where auction dynamics have become more fragile. For now, though, the combination of easy funding and solid balance sheets is a key reason why the broader system has absorbed recent equity volatility without a more severe credit shock. To wrap up, today's backdrop is cautiously defensive. Higher for longer Fed expectations and AI-driven volatility are pushing investors toward gold, staples, and alternative hedges, even as structural supports from AI earnings, international rotation, and strong credit markets keep the risk-on story alive beneath the surface. The balance of risks looks two-way, but with a clear premium on selectivity and liquidity. Watch upcoming inflation and labor data, AI regulation headlines, and any signs of credit stress for clues on whether this defensive posture hardens or eases. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.